I have the pleasure of discussing these papers. As I mentioned, I was very excited to be asked to discuss the FinTech panel because FinTech has become, I actually do a lot of research into small business finances and access to credit, and so FinTech has obviously popped up in that realm and has become, intriguing in how big an impact will it have in that world. Each of these papers really illustrate the continued importance of community banks in spite of technological innovations that are sweeping through the financial services industry. I remember I was at a conference about 7, 8 years ago, it all blends together, where there were a bunch of marketplace lenders in the room and online lenders in the room who came in and brashly told us that they were going to drive those dinosaur brick and mortar banks out of business. Okay. As we know, this really has not happened. It was a little bit Shakespearean, mostly sound and fury signifying nothing. Not quite nothing, because it does turn out that consumers, especially our young consumers, as we saw yesterday, really appreciate the convenience of being able to access their money electronically from the comfort of their pajamas. But fintechs do not have access to the relatively cheap and stable funding source that are consumer deposits. And they also don't have access to the conveniently ready supply consumers to give them all the advantages that they thought they were going to be able to take over the market. Okay, so as we stand today, it seems that fintech and banks and community banks are going to have to come to some middle ground and partner and share in going forward and how to best adapt. And again, these papers just highlight some of the ways that the fintech firms and the banks are coexisting pretty harmoniously. As was discussed yesterday, I think it was when they were discussing the results of the survey, community banks don't need to be on the leading edge to implement the technology, but they do need to adapt. And the nice part of being a community bank is the ability to adapt quickly. Community banks can be more agile. They don't have to go through as many layers of going up the food chart, up the food chain in terms of when things are going to happen and when things can happen. So I think community banks have the potential to have some advantages in bringing technology into their models. All right. So now for the individual papers. In the first paper, Kandorp and his co-author look at the mortgage originations in the years following the financial crisis. They document a nice steady retreat of the 4 largest commercial banks away from originating almost 35% of all mortgages in 2008, down to less than 10% by 2016. Over that same period, they also show that non-bank lenders go from 25% in 2008 to over 45% in 2016. All right? Their paper also nicely shows that during this period, the total share of mortgages that are originated by community banks, by small banks, is relatively constant, not a lot of changes. But what the interesting part of their results is that they show that in the local markets where the retreat of the big 4 was the largest, the small banks were the most responsive to this retreat. They were even more responsive than the non-banks. Again, highlighting the importance of community banks. I really liked this paper a lot. The analysis was quite detailed, and the authors did a lot of robustness checking. For those of you who care about those details, that was, I thought, really well done. I would encourage the authors to think about the implications of the rules on qualified mortgages may have on their findings going forward. The rules went into effect January 2015. Your data stop in 2016, and so for that last year, you might think that because as we heard yesterday, the rules on qualified mortgages are quite expensive for the community banks to implement. There may be, one might expect that there was a little bit of a retreat in this. The other The other thing that you might want to have a look at, are there any differences in the mortgages that are being originated that are held to maturity versus the ones that are sold in the secondary market? I believe you can tell that from the HMDA data, which ones. And so as part of your argument about why the community banks have an advantage over the non-banks is the securitization market, that the other guys have to go to the securitization market. You might be able to empirically test this looking at the loans that are set to be held to maturity and the ones that are set to be sold in the secondary market. And as a final comment, I really appreciate the fact that you tried to bring in consumer preferences into the model and looking at conversion rates. I question how good of a indicator you have, because you're looking at the fraction of loans that were accepted versus the ones that were made, and that is inherently correlated to where the loans, which party the loans went to, and so your measure of consumer preferences is correlated to the dependent variable and what you're trying to measure. And so I would encourage you to think a little more deeply about that. But I really liked the paper, and I appreciated all of the robustness checks that went into it. In the second paper, John and his co-authors use Prosper Online data to look at the fintech penetration in the presence of small banks in the market. Their results indicate that there is higher fintech penetration in areas with lower small bank preference. So basically, in a nutshell, they're finding that fintech is more of a substitute for large versus small banks, and that really that makes a lot of sense. We know that small businesses are really heterogeneous, and they do the touch and the relationship lending that is associated with small business lending gives some credence to this. Why this would make some sense. I would question including all loans to self-employed businesses in the construction of your small business loan measure. In my mind, this is akin to saying that all credit card debt held by self-employed persons should be counted as small business debt. Clearly, that's not something that we do at the Fed when we're looking at accounts. Maybe it should be. I know that there is a lot of commingling of small business assets and personal assets. I would be more convinced of your results if we could see something that just done for the small business loans themselves without the self-employed people. I'm not saying that some of that is not inherently going to the small business loans, but I don't think that all of it is. The other thing that I would question is when you're looking at the riskiness. I know that I have done of the loans and the likelihood to default. I know that I have done some analysis on the Lending Club data, which is, one would argue, a very similar platform. And the loans that are designated for small business purposes go bad much more often than the loans that are not small business purposes. Okay, and so again, this going back and commingling all the self-employed loans with the ones designated for small business, your results, I believe, would be made stronger if you could show me that these hold through for just the loans absolutely designated for small business purposes. The other thing that I'd like to say is sort of a self-serving thing. In some of the introductory remarks you made about 13% of there's a 13% reduction in large bank lending to small businesses. This is based on call report data, correct? Okay, so this is based on call report data, which is based on loans less than $1 million at origination, which we know is not the same as loans to small businesses. And so just be a little bit careful on how we quantify and qualify those. And this is more from my perspective that I think there needs to be better data on small business lending, and we absolutely do not have it. And so we just need to be a little more cognizant when we're talking about what's happening, to be aware that this is a proxy for small business lending, but it's not necessarily the same thing as. Okay. In the third paper, George and his co-author look at what implications technology implementation has on bank employment. Theoretically, if technology and employment are complementary, we should see an increase in employment as technology is increased. And if they're substitutes, we should see a decrease. The authors point out that unlike manufacturing, the relationship is likely to be more complementary, and in fact, that is what the data show. That as technology increases, so too does employment spending. I think that the very interesting results, I would encourage the authors to think carefully about your measures of technology spending and what is included and what is not included. And just to be more explicit about this, I found myself having to read the paper very, very closely to try to figure out exactly what your independent variable was that was measuring technology included. Your analysis looks at urban versus rural, but I didn't see anywhere in the paper. You said in your results that you looked at the results follow through for small versus large firms. But I didn't see those results in the paper, and so that would have been nice, and I think particularly relevant, particularly for this crowd, about what does technology spending do for small banks versus large banks. I was excited to see when we had our pre-conference call, I mentioned to George that it would be interesting to see what happened in light of all the mergers and acquisitions that have taken place over this period, that if you're not accounting for the mergers and acquisitions, it could be that a bank that had particularly strong technology was acquired because of its technology, and then your results are going to be skewed positively. It's going to look like growing your technology is going to grow your employment. I was pleased to see that George actually, in the 2 weeks between the call and the conference, went back and checked this out and said that is not the case, so that's encouraging. And then as a final note on the paper, the one thing that I would encourage you to go back and look at is you've talked about spending, you've talked about output, you've talked about employment, but what about profitability? We heard this morning that there was a bank that spent lots and lots of money to get access to Zelle, but the cost of it was obviously prohibitively expensive. So my question to you would be, if these firms are increasing their technology spending, is it doing it in a way that makes the bank more productive, in a way that makes the bank more profitable? Because it does, in the end, come down to whether or not this is a sustainable method, because we can grow and have more technology and hire lots more people and do more output. But if we're not doing so in a profitable way, it's not going to be a good thing for the bank in the long run. All right. My final comment has to do with, again, when we were on the phone with all of the authors, and Michael and I were on the phone call a couple weeks ago, in that I think that these papers in particular are at a disadvantage. Okay, because when we're looking at technology, and technology is evolving as rapidly as it is evolving, your results are kind of outdated before you get to the table, right? And we know this data is not perfect. Data doesn't come to us as quickly as we would like it to. And so by the time you get your results, you kind of have to go back and say, oh, well, that's really cool, but is it still relevant today? And this is something I mentioned particularly for the qualified mortgages, looking forward, and that does this still matter in the same way that it mattered previously? But I think this is something that all of the authors should think about. The marketplace lending underwent huge changes in 2017 in terms of, there are a lot of securitization problems, their default rates started to increase. And so what impact does the things that are going on in the market today, does that make your results hold through? Does it make them more or less relevant in what's going on? And I would encourage George in the same way in terms of technology, do these things still hold through? As an economist, I recognize that, we're not going to go back and update our data on a daily basis. It's not possible. We'll never get a research paper written. But just being able to take into account that, as time goes forward and our data become a little bit stale, what does that mean for our results, and can we put them into context? All right, but I enjoyed all the papers, and I really appreciated you guys' feedback and everything on the call, so thank you.